What's going on, everybody? Welcome back to Iron Sharpens. My name is Brad Marquis, and today we are here with Financial Coach Paapa Benyarko. What we're going to be doing is talking about financial literacy. We're going to give you some tips to keeping your finances in good standings. This is something that I was not taught, and a lot of young people are not taught in school growing up on how to manage your finances. We're not taught about the stock market. We're not taught about investing in real estate and things of that nature. So today I'm super excited to be able to offer this information, or Papa offer this information, because I'm a student. I'm here with you. I'm learning too.
Right.
You know, I want to make sure my finances in good standing, and you know, it's not all about having money. It's about putting yourself in a position to create income.
And managing it.
Managing it. Is that what you call it?
Managing
it,
yeah.
Right. And being able to not only manage it, but grow it. And so this is what we're going to be talking about today, and we hope that you get something out of it, you know, and I'm hoping to get something out of it. So first, we're going to bring Papa in. Papa, you know, talk to the people about, you know, how you got involved in this. Tell them about yourself, where you come from. Give them a little background on you.
Yes, so my name is Paapa Benyarko. I was born in Newark, New Jersey, raised in Irvington, New Jersey. It's a tough neighborhood, not well off by any means, but what we got there was determination. We saw hard work. We saw survival. Our parents, all we knew on a financial standpoint was how to survive, right? My mother always talked about it. We got to survive. We got to make it. But thriving was something I didn't see. I started going to a church, Change Church, that brought in a guy named George Thompson. And this guy, I'm telling you, changed my life as far as how I think about finances and invest, because I didn't know about investing. You see, Brad, a lot of us know about spending. A lot of us know about how to use money, but we don't know how to make it, right? So I learned that day how to make money, because through investing, it opened up a world that I didn't know as far as publicly traded companies. And this is stuff we're going to get into, but publicly traded company, privately traded, the fact that you can put something in 20 years, get something else out of it. You know, these things I just never knew about, and through that, it just opened up a whole new world that changed my life, my wife's life, and my family's life, and I just want to share it with everybody now.
All right, cool, man. Well, here, you know, Iron Sharpens, we're transparent, man. We're open, we're transparent. You know, we're about education, information, accountability. You know, give us a little bit about your background, because I know some things about you,
right,
and I think it can help some people out there.
Right. So
how were you growing up in the 90s and all of that? Like, what was your mindset? Like, where'd your money mindset come from? Because some folks like music.
Right.
Some folks like sports.
Right.
You like finances.
Yes.
Where did that drive come from?
I'll tell you a story.
Mm-hmm.
When I was growing up, my father owned a store, a corner store.
Mm-hmm.
You know, sold goods and had goods and had sold services. And I used to work the cash register.
Okay.
And when I worked the cash register, it was exciting to me.
Okay.
You know, doing the math on how much a person is supposed to get back. You know, okay, how much is the total?
Mm-hmm.
And it just opened up a door of understanding, like, of how money works.
Right.
I was like 9.
Right.
So after that store closed, through the years, I started like understanding, like, okay, you money is bigger than just a paycheck or like money you bring in, but it's also like it's a whole nother world out there that we don't know about as far as finances. But I never had a chance to understand it because nobody would ever show me.
Right.
So as I got introduced to George Thompson that day in a church, and he started talking about how you can invest in Apple, invest in Pepsi, invest in all these different companies. It just opened up a idea in my mind of, okay, I got to take that step.
Right.
So that's the gist of like how it all started for me. Just hearing information and then acting on that information.
All right. So here's what I'm hearing you say. Have you had first? We're talking about Mr. Thompson, who was a mentor. So he was
Well,
essentially a mentor.
he wasn't my mentor. He just came to speak. He was actually Pastor Darius Daniels' financial advisor, I believe.
Okay.
But he came to speak to the church at like a seminar.
Got you.
So we was in the crowd. I was in the crowd listening, getting intrigued.
Right.
And and then from there I took action.
Got you.
And, I read every book I can read on investing. I mean, whatever was popular, I jumped on it. So that's how that went.
And here's where where I want to go with that, because you're not talking about formal education in the field.
Right.
You actually did informal education in the field. So you actually went out yourself and gathered the information.
Right.
Now, how did you know what information to trust?
Well, if a lot of people spend their time online looking at whatever, or on social media looking at whatever, but I started watching CNBC a lot. So through CNBC, they would have various guests on there, and they would just give you the goods. They tell you, check this out, do this. Have you looked at this? I mean, throughout the day, from 8 in the morning to 6 at night with Jim Cramer, Mad Money Show, they would talk about all the things you can do, the books you can read. And life is like, if you really want to know something, you will get to understand it. So as I read one book, another book was suggested, I read that book. As I read that book, something else was suggested, I check that out. And it's just something, if you have interest in, like anything else with anybody else, if you have interest in it, you would just seek the information.
Right.
So that's pretty much like what that was. Just a general old-fashioned interest.
So where did you start? Did you start in your home with managing your finances and getting those together? Did you start with investing? Did you start stocks, real estate? Where did you start?
Well, I always believed in a budget. So before I even knew what a budget was, it just made sense to me that all the money that I have.
And for those who don't know what a budget is, just let's break it down.
Okay, a budget is basically summarizing how much money that you bring in a month versus the bills that you have, and it should come out to zero at the end of the calculation of each. So everybody don't have a budget, and if they did, they'll realize, okay, I have more a month than money. So
more bills a month than money.
I had the month goes way longer than my money goes, so that's a problem. So I always believed in, okay, I get paid every 2 weeks, I'm gonna bring that against the bills I have, and then we'll take it from there. So budgeting came naturally to me. When I got married, though, it didn't come naturally to my wife, and I had to convince her of it. But for me, it always made sense to add up how much I'm bringing in versus how much is going out. So I started with the budget. That's number one. And from there, started with investing. And also, what happened was, because when I got married, my wife had some debt. So we end up having to deal with debt and how to pay that off. And because what happens is, a lot of people don't understand is, if you can just pay off some of your debt, you actually have more money throughout the month. See, a lot of people don't calculate it like that, because they're not looking at the fact that a car can actually be paid off. You know what I mean? They under the assumption that you always have to have a car new.
Right.
Your mortgage can be paid off.
Right.
These things can be paid off, so you don't have to pay it anymore. But people, they get in their mind like these are things that's always are like the light bill or something, and it's not.
Right.
So if you take those out of the equation, you'll find that you actually make more than you think.
Right. Do you have a method for paying down debt? Do you have a system for that?
Well, it's the same method as Dave Ramsey has. And anybody that want to know about Dave Ramsey could check him out. But it's a snowball method, which means that you take the biggest bill the smallest bill. You take the smallest bill that you have, you pay it off, and you don't spend that money now. You add it. Well, first of all, you have to have a multiplier. So let's say you have to take $100 or $200, something that you're using to just start off paying off the debt. Once you pay off the first bill, you don't spend that money. you take the money and you add it to it. So once you add to it, then you pay off the next one. Don't spend it though. Now you gotta the number keeps growing.
Right.
So you've went from $100 to pay off bills to now maybe $700.
Okay. So
to pay off bills.
Here's what I think. Let me just for clarification, so I'm knowing. So
Right.
we have a bill here for I guess we have a $100 credit card bill.
Right.
So we add $100 on top of that. So we're actually paying $200 into a $100 monthly card.
Well, no. Let's say you have the bill, not the bill, but the monthly payment.
Right.
So the bill can be $2,000.
Right. The monthly payment is
maybe like $30 a month.
All right. So
something like that.
Yeah, that's what I was going with.
Right.
So that's what I meant when I said
Okay.
that, not the full balance.
Right.
But the actual monthly payment
Right.
is say $100.
Right.
So you pay $100 on top of that.
Well, you can start your multiplier can be with so like the money you say I'm gonna use this money to tackle debt.
Right.
Can be anything.
Right.
You could be $200. It could be $80.
Got you.
So you're gonna use that money for your smallest monthly bill.
Right.
And when you knock that out, then you can take the money you had plus whatever that monthly bill was and add it to it,
Right.
and then jump on the next bill.
So we're not spending after we paid off that account. We're not spending that $100. We're taking that $100 that we was using that bill and we're adding it to the next bill.
Yeah.
So now we that.
Plus the multiplier.
That's the multiplier.
Plus the multiplier.
Plus the multiplier.
Yes.
Okay.
Yeah.
So if the bill was $100 a month, we're paying $200 into that $100 bill. Once we knock that out, so now we have $300 that we're paying into the next bill.
Into the next one.
Right.
Yeah.
And so once we knock that once that next bill is knocked out, whatever we were paying into that next bill plus the multiplier.
Right. And if you just want to say that, now you got $600.
Now you got $600.
Yeah. So now you're paying on next. So and that's how you knock out car notes in a year.
Right.
That's how you knock out student loan payments.
Right.
That's how you knock out car notes.
Right.
Yeah.
Right.
So that's and credit card bills.
Right. How did you said your wife was not good at budgeting or she didn't budget a lot when you guys got married.
No.
How did you convince her to get on your wave?
We had to have a real argument about it. And I told her one time, I said, well, you could clearly see I'm good with money because I don't have any debt. So to be our age, we was 20, 31, 32.
Which is incredible.
Yeah.
Not have debt.
Yeah, I didn't have anything. I drove an old Honda Accord at the time, and all that stuff. So, and she had a lot of debt. So I said, clearly I got to know what I'm doing.
Yeah.
So you got to trust me on this one.
Right.
And let me lead.
Right.
And it just was like, all right, yeah, I see what you're doing. So let's start a joint account.
Right.
We're gonna have, so how I do it with a budget, have a joint account. All the bills are written down and itemized as far as how much they are, down to the groceries. And then I also add in there how much we plan on saving a month. So that's part of our monthly bills. So in the beginning, we wasn't using that number to save. We was using that money to knock down debt.
Okay.
So that's how we got that. We used that number that we planned on one day saving. We couldn't do it at the time.
Right.
To knock down the debt.
Right.
And then we started. That was our multiplier.
Got you.
So we took that and we knocked off the debt. And as she saw like stuff start getting paid off, and it was like, oh, okay, yeah, this is real. And
just for those who are like me when I was first starting out, when he's mentioning multiplier, basically if you got your monthly balance is $100, if you're only paying that $100, you're not knocking down your debt.
No, because of the interest.
Because of the interest, and so you have to put something on top of that.
You got to put something on top
in order to start knocking off that interest. So that's what he means by multiplier. You add, and then we continue to stack on stack until all the bills are paid off.
Yeah.
What do you think some of the common mistakes are? That put people in debt?
Let me see. I don't think like everybody else. So I know you might hear me say something and Dave, okay, I see what he doing. No. I don't think like everybody else. So I think there is a time to be in debt. When the interest rates was at zero, and you can get a loan for 1.8%. I don't see what was the real issue with that. Or you can get a credit card with 0 interest for a year. Okay, I'm not against that. So a lot of people that might be speaking about debt, they might say, "Oh, no, that no, zero, nothing." I'm like, nah, but what's the situation going on in the world? What's happening? Like, what? So right now, that interest rates is moving up. We a 30-year fixed mortgage rate right now is like 8%. So so now that it's kind of time to step back from debt, because the banks are going to, they about to make some money. So, you want to get away from it now. You want to so like if you was in it, 2020, 2019, now it's time to step away, because this is, you're going to realize you're going to start losing now. So, what was the question?
What common mistakes do you see individuals make to put them in debt?
See, this it's a lot of people have a lot of emotion tied to their lifestyle and like things that they have. So even if they find things are going up in price, stuff has changed, they will continue to do said thing, live said life, and they realize they can't really afford it no more. So now they figure, well, let me just start using my credit card. One credit card turns into 2, turns into 3. And then they say to themselves, well, I can't go without a trip. I've been taking trips. I can't go without, I can't, And then these choices, that's how it all started. You can be $20,000 in debt tomorrow. I mean, it's quick.
Right. You come out of college, $100,000 in debt.
And that's like a whole nother thing. So now, even with Biden canceling a lot of the student loan debt, it's still millions of people that's dealing with this student loan debt, and it's very unfortunate, because it shouldn't be that way.
Yeah, it's all about the interest. It's all about the compound interest. All about the way I gotta talk about that. I know a little bit.
That's my co-host. I'm telling you.
Sure. but what I was gonna talk about. So, where did educating others come in? When did coaching others come in? How did you get into coaching? You spoke about Dave Ramsey and the certification that you got. Talk a little bit more about that process.
Yeah, so it really came from being pissed off. I see a lot of people are caught up and get really trapped into what they hear from a lot of people on social media, or how to manage money, or how to. But it's really, a lot of it is bad information, because it's like get rich quick schemes. A lot of people are falling for, and they just believe like so simple that to like be out to, as far as debt, investing, these things, and budgeting, these things aren't simple, and it needs to be managed and paid attention to on a like a week to 2 weeks to a bi-weekly or monthly basis. But a lot of people can think like it's so like a microwave kind of concept.
Yeah.
So
get rich quick.
Yes. So as one day I was in church, and the guy asked me, "Hey man, like, what can I?" Because we've been talking a lot, and he said, "How can I? What can I do to get some of your services, as far as like helping me with this investment thing? Because I just want to learn how the stock market works." So I said, okay. And so, I became a coach through Dave Ramsey program, and I started a business, and then I started coaching and just trying to help people. But it came from a notion of, people don't know, that's older than me, what to do. And they're getting a lot of tidbits from somebody walking down the street, that just might be giving them advice or just telling them something, and they just going with it, a story. So it was this fund that a guy created that a lot of people loved on social media, and it was a real estate fund, and a lot of people jumped on it, and they asked me, hey, you gonna jump on this fund? I said, well, the stock market been around since 17 something. I don't need to jump on any special funds. You can get a 13% return on average from the stock market. There's nothing to jump on. What we need is right in front of our face. And they couldn't understand, like, you're dodging something that's been around for 500-600 years to jump on something that you just heard about from your cousin.
Right.
And I'm like, that's the problem with a lot of people when it comes to social media. They missing the mark of what's in front of them.
Right.
And I just say we need to just get back to the ground level and understand, like, this thing is not that hard.
So explain this. Explain the mark. Explain the stock market. I know you mentioned something. One of your goals is destigmify the stock market. What does that mean to you?
Yeah, so it's just a matter of understanding the stock market isn't hard. In layman's terms, it's I like to make things to where a fifth grader can understand it, but it is a little more complicated than that. But just a general understanding. If you start a business, me and you start a business, and we needed more capital, we're doing great. We need more money to expand. All we're gonna do is take our company and make it public for other people, for the world to invest in it, instead of just a few people. So we're bringing it to the stock market. Hey, stock market, we got this company. Put it on your platform, so everybody can now invest around the world. And that's pretty much what it is. Where we're going to issue these, we're going to keep some of our shares. We're going to slice up our company in the pie. We're going to keep some of our shares, and we're going to make some of it public. So all the shares are not public. Like, if you ever look at Walmart, the Waltons still control the bulk. They make sure they control 51%,
right,
and won't let that go. But you can invest in Walmart,
right,
and you could have became a millionaire back in the 80s,
right,
and things of that nature.
Right. And when you own stock, you own a part of that company.
You own a piece of the company, yeah. It won't be much, but it's something, and that's what I tell people. Like, that's the only thing where you can work at McDonald's and own a piece of the company of McDonald's if you buy in their stock
at the same time, right?
Yeah, and if you own it long enough, a lot of these companies have turned a lot of people into millionaires.
So let's talk about that part of the stock market. Like, how much, are good investments? Is it something, do you just invest and leave it, or do you continue to watch it, as the money grow? How long do you keep it in there? Like, some folks, like you said, you're on the internet, you're trying to get rich quick.
Right.
So is the stock market a place, a get rich quick kind of thing, or is it, like, how do you massage that?
Yeah, so I think a lot of people mix up investing with options trading or just trading. There's a lot of trading you can do. Options trading is great. I do options trading.
Option trading is what?
Options trading is when you buying a contract. You're buying contracts of a company. So, like, you're buying contracts of a stock. So you're not investing in the company. You're buying, like, it's derivatives, which I have to explain. Derivatives, I really can't. But
that's why you got to call them, man.
You got to call, yeah. You got to. It's too much. Yeah, but you're buying contracts. You're buying contracts, and you're not actually investing in the company.
Right. Okay.
So, but with that's trading.
Right.
So, and they got other kind of trading. But
well, let's stick to stocks. Right?
Yeah. So investing in stock. But that's what a lot of people think when they talk about getting rich.
Okay. Real
quick, because if you options trading, you're buying 100 shares. You're buying one contract is 100 shares.
Okay.
So you're buying a contract of 100 shares for one. So it's you can get a little quicker, make money a little quicker, and you can lose a little quicker.
Got you.
So if you're investing in the company, is like, for me, it's always a no-brainer as far as investing in companies that you love, that you see, not that you use. The whole investing only in companies that you use, that's not true. Invest in companies that's on the tip of everybody's tongue. So when you saw, like, a Tesla in every neighborhood, that was like, your mind should start racing. Like, wait a minute, I'm on the highway. Back 5 years ago when you said, wait a minute, I saw him in California, I saw him in New Jersey. Something's not right with this Tesla. Let me go check this thing out. So, your wheels get to turning like that, even back in the day, when you saw a Home Depot popping up in every neighborhood, your mind should have got to turning. Wait a minute, I'm seeing these things pop up all over. So that's an investor mind. So, and that's how you just to get the gears turning in your head about what to invest in.
Right.
And then you go on, you can go on CNBC, you can go check out these different places. Is this thing are they talking about it like that? Like how I see it?
Right.
And then you can, if you want to really get into the nitty gritty of it all, you can go listen to earnings calls of these companies. They have an app, like listen to the earnings call app.
What's an earnings call?
Earnings call. So most companies report quarterly. Okay. So as quarters go, in the stock market, we are in I think the third or fourth quarter right now.
Yeah, third quarter.
Third quarter. So like so there's quarters, and then and the companies report on how they're doing, and stocks can go up and down based on it. So they have calls, these companies, and they tell you, the CEO, the CFO, they tell you how they're doing. They tell you about it, like, hey, we didn't make any money, but next quarter maybe we can do better. And what's most important about the earnings call is the outlook, the forward outlook. So,
and that's what I was going to ask you. Do they have reasons why they feel they're going to do better than the next quarter?
They'll tell you. Yeah, they'll tell you, like, because all that matters is the future in the stock market. It's never the present. So when you're an investor, you always want to know about the future, right? So like, all right, the future, we're projected to do this number, that number. They're getting excited. I'm excited. We all excited. We high fiving. I'm running to go invest. So that's the stuff that you want to do if you're going to invest in a company. You really want to check it out.
Right. Say you got Tesla. It's not only just,
and we're not telling you to buy a Tesla.
Yeah, we're not saying buy Tesla, but we're using that as an example. As you have Tesla, but it's not just Tesla. It's the parts. It's the people who make the parts for Tesla. It's the system. It's the charging system that Tesla uses, or the cars that use electric. So it's not just necessarily investing in that company, Tesla, but maybe the engine is made by somebody else. Maybe the system, whatever I forget what it is, what they use to charge the cars up with, but maybe that charging dock is made by a different company. But if you know that electric cars are booming and electric cars are going to be everywhere, maybe you don't necessarily want to invest in an electric car. Maybe you want to invest in whoever creates parts for the electric car, whoever creates the chargers for the electric cars, like those types of things. And so now you're really getting down to the nitty gritty, because it may just be Tesla, but then you may have parts that are in Tesla, Ford, Chevy. I mean, so there are parts that may be in all the cars, and you may make more money on those parts than necessarily that actual company. Like Samsung. Samsung, correct me if I'm wrong, I believe Samsung makes a lot of parts for the Apple phone. So when you're purchasing an Apple phone, Samsung is still making money. Regardless if you're buying a Samsung or an Apple, they're still making money, because Samsung, they create certain parts for the Apple phone. So, it might behoove you. So you might want to invest in Apple, which is, I've never heard that's a bad investment. I own stock in Apple, but I'm not the guru. I'm not the advisor here, the consultant there. Just a little bit of what I do. But so what do you think about that idea?
So, all right. So now we're here. So I'm gonna try to break this down so make it simple. You have to be careful with that, I would say, because a lot of companies big companies own a lot of the little things that move and make the little things that are in the big thing. And it's a small percentage of what they do. So let's say you might have Gillette was bought out by, I forgot who they was bought out by, but just because Gillette is booming, that company might not be doing well. That's the only good thing that they have in the pipeline. So it's like you have to make sure, if you invest in the smaller companies, that is that all that they do, or is it just or is that thing a small percentage of what they do?
Right.
So you have to look at that, and then also when it comes to investing in companies, you have to see, one, is it a growth company? Like, this is you have to have an investing style. So your investing style, based on your age and how much time you have that you think you have on this earth, you have to realize, is this a growth company, or is it a cyclical company? Or,
explain growth cyclical.
So growth companies are companies that just came to be public. They might have been here for a while, but they just came public, and they have a lot of room to expand.
Okay.
So you don't see them all over the place like a Canva.
Okay.
So new restaurant, and they're popping up all over the place. Okay, that's exciting. Five Below, something like that.
Right.
Even Amazon is still considered a growth company.
Right.
So, but then you have these cyclical companies are just mainly like that's mainly like the airlines and things that do well in certain seasons.
They are who they are.
Yeah, and they don't do well all the time. They have their moments.
Got you.
So the car companies and things like that. But then you have stocks that's been here for a while, and it might be like a Costco or a Home Depot. They've been here for a while, and you mainly get a dividend from them. That's why you hold it. You don't really buy it. You like it, but if you don't have a lot of income to put behind them, the dividend that they're going to give you isn't worth it.
So you drop in terms now, dividend.
Yeah, so the dividend is basically what a lot of companies that's been around for a long time will give you for having their stock.
Okay.
They know that their stock is not going up. Nobody makes money buying Procter & Gamble on a dollar to dollar basis, but they know we'll give you, hey, you have $1 million with us, we'll give you a dividend, and
so
this stuff is actually on your taxes. You know what I mean?
So it's like interest.
It's like interest. Basically like interest. Yeah, this is the easiest way to put it. It's like interest. It's like having interest, and it's like just like dealing with your bank. But actually, your money's is a little more at risk because it's in a stock. Gotcha. So usually the dividends was supposed to be higher than what banks were offering.
What's the dividend? Is the dividend based on the market? Is dividend based on their projected sales? And so what is that based on?
As far as I know, the dividend is based on what they want to do, because they can cut the dividend, they can raise it. A company can. It's all about how much money they want to allocate that way.
Got you.
Because they're bringing in so much money, the stock is not moving anymore because they've been around for a while.
Right.
Like a Schmuckers or a Hershey or Coca-Cola, their stock been around for a long time, and it is not going to go up really, but they can give you some income
to keep you invested.
Yeah,
right.
They have to do something to keep you invested. Now, growth companies not going to have a dividend because you can make the money actually owning the stock
on the growth.
And they can split it. They can split the stock, and you can keep on having it like Apple has split so many times.
Right. How do you know when to buy and when to sell?
Well, I always tell people it's all about your belief in the company. So if you're buying, let's backtrack. So some people, if you're going to just be, some people might just want to get into dividends or ETFs, and that's fine. That's a basket of stocks all put into a fund.
No, I just got hip to ETFs. I picked up some ETFs over the last few years, but ETFs is, like you just said, it's a basket of stuff, so you may have, I don't know.
It's called an exchange traded fund.
Right, and you may have, Apple in there, you may have Samsung in there, Tesla's in there,
depending on what it's for.
Depending on what it's for, if it's for technology, if it's for, lifestyle, whatever it is. But, like I said, I'm not gonna sit here and act like I know all of this stuff.
you know.
I know some things. I know enough to do a little something, but I ain't educate nobody on that.
You know a little something. Go ahead, tell what you know.
But so you can pick up a package of stocks, and so they're kind of playing against each other. So I guess it's a less opportunity to lose money on that.
Because they have a small percentage of ownership,
right,
in each one.
Right.
That it shoulders a brunt force that's coming against the one stock.
Right.
You have a lot of them in there.
So if one is doing bad, the other ones might balance it out or bring it up or something.
Right. So that based on percentage.
Based on percentages, right.
Yeah.
what would you have done differently over the last 15, 20 years, to improve, you're good now, but what do you think could have made it better? Any things you would have changed over the last 15, 20 years and how you managed your money or invested?
I would have just got around a better group of people.
Okay.
I think people underestimate how like the people you hang around can affect you and your finances, because based on the people that you are hanging around when you're young, you could either buy buildings and rent them out, or you could spend all your money at the mall. It's like that. It's like that clear cut, based on who you hang around, who's your best friend, who's your cousin. You can't choose your cousins, but who's your friends. You know what I mean? So I would have been more conscious of that. Like, all right, I gotta start hanging with a better group of people.
But that goes back to just our lack of knowledge. That goes back to, they don't teach this, and they teach us history, they teach us science, but they don't teach us financial literacy in high school. They don't teach us that in college. These are like electives, or unless you choose to go into college as for finances or for economics or things of that nature. We don't learn these things. We learn these things in the school of hard knocks.
Right.
So it's very difficult to even, and I'll speak for myself, it's very difficult to even know these are the steps that I need to be taking.
Right.
Actually, I got hip to that method, that multiplier method, through Will Johnson at church, because he did a financial seminar at church, Change Church.
Yep.
We both go there. This is where we met. In men's groups, things of that nature, and that's why we're here again. Why not bring in the folks that I break bread with and grow with on Iron Sharpens. So, and this is what we're doing. We're sharpening our iron. We're passing this information back and forth to each other and on to you. And my guy Will Johnson, me and my wife, we went and sat in. Actually, she wasn't even my wife at the time. We were still dating. But we sat in that and we got on the same wave about eliminating debt. And he mentioned the multiplier, and I went ahead and did that. Actually, it's funny. And going back to your good debt thing. I remember, because good debt, meaning that, you want to, when you go to get loans, when you go to get things of that nature, they want to see what your credit history is. They want to see how you pay your debts back, how you pay your bills
pretty
back.
much how it works.
So if you don't have any debts, you're probably not going to get a loan. You're probably not, because they don't know what your history is. So you got to carry something. And they normally say keep it short of 50, keep it short of what, 30% or something like that. They want you to have debt, but not too much debt. So you want to keep it short of, I would say 30%. So if you got a credit card for $100, maybe you keep 30 on it. That's considering you don't have, a loan, a car loan or mortgage or something like that. But you need to be able to show good history with your credit. History is a big thing. But again, when I first started out, I was massively in debt, and massively for me. I'm not going to say, it's relative.
It's relative. That's why everything is relative.
It's relative. My debt might have been a drop in a bucket for somebody.
Everything is relative.
It's relative. I don't suggest this for anybody, but one thing that I did, my debt I was paying off all my bills. I was paying everything on time. My credit score was plus 700, whatever. But my debt to income was nothing. And going back to your original point, my bills exceeded what I was making. So I was paying off all my bills. But if I was bringing in $1,000, if I was bringing in $2,000 a month, I was spending $2,500 or whatever. I was spending,
and they can calculate it.
It can calculate. So I can, I could, my bills were paid, but I couldn't get a mortgage because my debt to income was crazy. I couldn't get a loan from anything because my debt to income was crazy. So they knew even if they gave me a loan, I wouldn't be able to pay it back. And so one of the things I said, okay, I could spend forever, trying to pay down these debts and do it the Dave Ramsey, multiplier way, all in that. And then I realized, that was going to take me forever to do. I had a chunk of change coming in that I knew I was, going to earn, coming down the road. So I had this thought, and again, it was almost like filing bankruptcy, where I just stopped paying on all of my debt. And I let them go into, because I had already had my crib, I already had my car, everything I needed, I already had, and I knew I wasn't going to be making any major purchases for the next 2 or 3 years. So I said, you know what, I'm going to sink my credit.
Right, yeah.
And so I sunk
that.
my credit I stopped paying on all my bills for 6 months until the creditors decided they wanted to settle.
Right, settle, yeah.
Settle.
Yeah.
And then I knew I had a chunk of change coming in. So once I got the chunk of change, you know, I went ahead and settled with all of my creditors because at this point they just wanted to take anything.
Right,
I don't say anything, but they were taking, you know, if I owed them 1,000, they were willing to take 700.
Right. Now, we don't advise this.
I'm not advising.
Pay your debt.
Pay your debt. But
that was like a genius kind of,
because it's always, there's repercussions of that too.
Yeah.
You know, because now my credit is sunk and now I have a negative credit, you know. I had to close.
Talk about all of it,
I had to close a lot of my long-standing credit cards. So, but those long-standing credit cards were good for my credit history, which messed up my credit history because now I don't have my Macy's. I don't have certain credit cards that I had very good payment history on.
Got you.
You know, because again, I was great. I was paying my bills. Right. But my debt to income.
It was going to take you a while to knock it all out.
Right. And so, you know, and I didn't have enough debt to file bankruptcy.
Right. And also you wanted to do something in the near future.
Right. In the future.
That you like near future.
You
had to get this thing together.
And I didn't need anything at the time.
Okay.
Like I didn't need to buy a house. I didn't need to buy a car. I didn't need any investments. All that stuff was taken care of. So I had a window to get everything back on track in a faster way than I could have.
But let me ask you something. Why was you such in a hurry to get all this done?
I knew it was going to cost me more in the long run than it would have been just to sink everything and start fresh. I calculated the numbers and you want me to dink and dunk, but you still going to be killing me with interest.
Right.
You know, and if I just sink it right now, I can, and these are the cards I kept the cards I wanted to keep, and got rid of the cards I didn't really need. You know, I was one of those college students living on credit cards, not knowing how the system worked.
How many did you have?
More than I needed.
How many?
Five, 6.
That's not a lot. I think I had 20.
But I was paying bills. I was literally paying bills with credit cards. I was living off of credit cards.
Yeah, there's a lot of people doing that.
Yeah, and I was like, but you never win that.
No,
you never win that because they're getting more money than you're actually, able to use.
Right.
Because what you got, a $2,000, $3,000 balance, $500 balance, $1,000 balance.
Some people give you $20,000 balance these days.
It wasn't me.
Yeah.
I'm glad they didn't. Give me a $20,000 balance because I might have. And with that frame of mind I had prior, I would have wrecked it.
It's like a drug.
It's a drug.
Yeah,
I would have wrecked it.
It's a drug.
Because it adds up. The 100 here, the 5 there. Oh, let me get that PlayStation 5. Oh, let me get them $200 J. Let me get.
It's a drug.
I got to go grocery shop. You spend $200-$300 on a grocery store. Like you're spending credit as opposed to cash.
Right.
And that interest, and you 29.9% interest rates and all of that because your credit is not good.
Right.
So they'll give you the card, but they didn't tell you they give you a 27, 28, 29% interest rate on that.
And I was talking to my uncle the other day, and he was and I tell people shop around. Like if you going if you need a credit card and you're going to get into it, a lot of people do. I'm not endorsing nothing, but I like credit unions more than I like banks.
Yep.
Usually the interest is lower on their credit cards,
right.
And they have all kinds of programs. A lot of them run I have a Alliant credit union that's tied to the airline industry, and they give you a credit card for interest free for a year. And things like that. They have these programs that they run. It's just way more consumer friendly with the credit unions versus the banks. So he didn't know that he was paying 29% interest with the bank on his credit. He didn't even know. I said, wow. And he ended up consolidating and going with the credit union once he found out, because they were saying 9%. When he was paying 29%. I said, this is stuff like we don't really pay attention to. I told him we've gotten to a position where we're just so happy that someone wants our business. We don't even look at, we trying to run out the door before they say no.
But they get the information in a stack of paperwork this thick, and that you need a lawyer to read through, and that everything is in fine print on what your responsibilities are. But you just so happy to get that loan. You're so happy to get that money.
But in 2023, I beg to differ, because a lot of times when you go online and you have your online ATM thing set up, they'll show you the interest if they have like a page in your online.
They got the little box with the thing.
It'll tell you the interest, and if you can navigate your online profile, everything's right there. So it's just a matter of, do we really want to know?
That's what it is. You see that number, you like, how much you get? It's what they giving me.
I wish they never told me. I don't even want to know.
Like, I ain't worried about that. It ain't gonna happen.
Right. Yeah. I'll pay this off this month.
That right.
Yeah, this enough. I'm gonna pay it off this month, and they give it 2% interest. Yeah.
Oh, I get cash back.
Yeah.
That 2% cash back.
I'll be like, come on, y'all. We can't be this gullible.
Yo, man, they giving me 2% now.
Yeah. So I mean, if you, like I said, if we set up our account, our budget, which led to saving, because our budget, a saving amount is in the budget. Mm-hmm. You will see over a year, over 2, over 3 years. Wow. And don't touch the savings. You will see, like, I have more money in my savings than the credit card can offer me. Mm-hmm. And I can just deal with that.
What do you think about this new trend that's happening where PayPal and Apple have savings accounts now? And it's not, I think Apple's is through Goldman Sachs or what have you, but they're I guess they're attaching their money transfer companies or whatever, or attaching themselves to banks, right. And now they're offering, savings accounts online with higher interest rates than your normal bank would. What do you think about those?
Yeah, I love what Apple is doing with Goldman Sachs, and they have their savings account tied with that. I think technology has made a disruption that's needed in the financial industry. Like, technology has really brought things down. Let me tell you something.
And it is FDIC insured.
Yes,
up to $250,000.
Yeah, that's that's nothing. Apple would never do that. Don't
have to be.
Right, but Apple would never even. That's why I like, because Apple is such a strong company. They would never even go that route, and because they're backed by a bank. Goldman Sachs is like world renowned. Right. You know what I mean? Right. And the thing I love about technology now, because what happened with even Robinhood is, and these other entities, they disrupted the status quo industry so much that they've brought the fees and payments and things like that of the responsibility of the consumer down. Mm-hmm. So it used to be, you had to pay, like when I started in the stock market, you had to pay $10 to buy and sell. Mm-hmm. Now that's free, because Robinhood came along and they started stealing everybody's customers. So these guys had to keep up. Wait a minute. Right. Oh my goodness, free. Right. So we got to come along. And the same thing with the bank. So then you had stuff like Ally Bank and Chime and all these different kind of online only banks that came into the industry. Online only, and you start to think about it. Wait a minute, I don't really need a branch to go into. I online only, perfect. And they're connected to ATMs in my area, all over. Any Wawa, if you live in Jersey, any Wawa, check a quick check, your Costco, you can go in there and use their ATMs surcharge free. Right. And so you realize you really don't even
make
need
investments.
No, to get money out.
To get money out.
Yeah. So you don't really need a physical location. So with online banking, it's eliminated all the fees that Wells Fargo and TD TD Bank would charge. They said no fees for overdrafting and moving your money, no fees for this stuff. So it's a game changer. Yeah. These entities that only operate online, right? Because the brick and mortars have made it to where in the past everything was a charge. Right. Oh my gosh, you overdrafted. Right. We had to move your own money into your checking, $20. Right. And it's like, wait a minute, but it's all my money.
It's all my money. Right. Why did you charge me to move my money?
Yeah.
When you could have just took my money.
And then meanwhile, my credit union is like, they move my money over, give me a call. Hey, we had to move your money. Do you want us to just transfer?
Right. So you don't fees.
No fees. Yeah.
And that's how the Apple credit card works. Apple, they don't have a lot of fees. They got the interest rates or what have you, but they don't have their claim to fame is no fees, no late charges, no overdraft, all of that.
Right.
And then you can actually attach your savings account. You can get an Apple savings account at 4.5% interest right now, and attach it to your credit card. So the money just moves freely back and forth.
Right.
And you can make, and then you got Apple Pay, you got Apple so like you said, they're streamlining the whole financial system, for you.
Yes.
Which is crazy. I've been thinking about moving my money over to Apple.
Yes.
So just
and technology is the disruptor that this world needs, because a lot of the old guard of finances and financial institutions thought like they would never be trumped in any way, and so they have had these kind of things in place where it's like a fee and a charge for everything.
Okay.
But that's why they don't like Robinhood.
Right.
And I'm not a big proponent of Robinhood, but I love what they're doing. Now they even started 24-hour trading. I said, man, Robinhood, y'all some bad boys. Because that stuff wasn't available to the everyday person. That's institutional stuff.
So we gonna wrap this up real quick on this last question. Last couple questions, but I started with Robinhood, and I can't even at this point I can't even remember why I stopped with Robinhood, but I ended up moving over to TD Ameritrade, and which is now Charles Schwab. So where what is your impression of Robinhood, and where would you start out if you were just starting, you want to start investing? Where would you advise someone to start?
All those online brokerage accounts, you need a brokerage account. And all those online brokerage accounts offer you to invest your money in stock market. So they're all pretty much good. The E-Trade, TD Ameritrade, just something that's used by a lot. Fidelity, that's used by the industry of financial people as a whole. So. And Robinhood got a bad rap. It's a way you could start, but once you start having like a real lot of like 500,000 and anything big money, you want to be in something that the institutions are using, and
something a little more trusted.
Yeah,
and secure.
just what the institutions that these big wigs that manage money are using. And TD Ameritrade has been around forever, and they well trusted. Right. So and then I would go there, and like I said, they all do the same thing.
Merrill Lynch,
they all do the same thing. They all do the same thing. One is not really better than the other. It's just an engine to use to access the public markets, public stock market. That's pretty much what they are. And
a lot of those institutions claim to have people, or they do have people that help you, navigate the stock market as an agent. Or you can call my man here, hire my man here, and he can consult you on it, coach you on it. So how would they find you? How do they get in contact with you for coaching opportunities?
So right now, you can pretty much just follow me on Instagram, on Facebook, and DM me. My name is Paapa Benyarko, Paapa, last name Benyarko.
And we'll put it on the lower third.
And, you follow me on Instagram and social media, and then just DM me, and we can get it's organic. I want to make stuff simple. So many people, I really don't like the way, because you can't get a financial advisor to even take your call if you don't have 250,000. So what about the guy with 20,000, or what about the guy with $10?
Yeah.
They're not worthy of learning how to invest. So
because they could, if you know what you're doing, you could probably turn that into something.
You can turn it into something one day. And that's the thing. They just say, oh, put your money in the 401k and don't bother me. But you can do your own thing, and that's going to be more lucrative to you anyway, because with 401ks you can't take it out till you're 59 and a half unless you want to get 10% penalty. So you don't want to get caught up in that too much. You want to be able to do your own thing and have your space. So.
Well, I appreciate it. Appreciate you coming through. Appreciate you dropping knowledge on the Iron Sharpens, man. And hopefully we help somebody out there. Please look for Paapa. He does excellent, wonderful videos on his Instagram where he's dropping little nuggets and educating the general pop on just what to do and how to do it. I love those videos. Please keep them going, my guy.
And
that's what we're here to do. The iron's here to sharpen iron, man.
Yeah.
And we do that all day long, whether we in this booth or not, you
Yeah.
know. So thank you for tuning in. Again, Brad Marquis, and we appreciate you.
All right.